In this video, I'll be going over the Chapter 2 homework problems. Now, it's really important that you understand the different concepts in Chapter 2 because the math itself is not difficult. We're doing mostly just adding or subtracting depending on the problem, but what you really have to understand is the definitions of the different concepts. That way you know what applies to each problem. So in this problem, we're working with our balance sheet, specifically assets and liabilities. So you're going to use the following balance sheet items given to you and its amounts, and you'll calculate the total liquid assets and the total current liabilities. So in part A, for our total liquid assets, the definition of that is the cash and items of value that can easily be converted to cash. So in this case, looking at our different balance sheet items, we can see that the money market account and the checking account are the two assets that can easily be converted to cash. So we'll go ahead and add these two numbers together, and so our total liquid assets is $3,380. Looking at part B, we're going to be finding the total current liabilities. In other words, it's the debts to be paid typically within the year. So current means the short-term liabilities that you have to pay off soon. And so looking at our balance sheet items again, the two that would be considered current liabilities are the medical bills and your credit card balance. Again, if you think about it, your medical bills, the hospital, your doctor likely wants to get paid soon or within the year. And your credit card balance, you can't just wait till next year to pay. You're likely paying on a monthly basis. So some portion or all of this will get paid within the year. So when I add those two numbers up, we will get $751 for our total current liabilities. So as you can see, the math is not too difficult. It's really identifying the correct concepts that apply. So in this next problem, we're still working with the balance sheet. You're given these items here to work with, and you're going to determine different components of the balance sheet. So in this part A, we're looking at total assets. In other words, we want to identify all the cash and property that has a monetary value. So as we look through, I'm going to go ahead and check off each item that would fall under this category. So going down the items, we've got a savings account balance of $1,890. We have an automobile that has a current value of $8,800. And we continue to go down. We also own video equipment of $2,350. As we go down some more, we have a personal computer valued at $1,200. And we go to the next column, we can see we've got cash in our checking account of $450. Going down further, we can see we've got household possessions at $3,400. And if I continue down, last but not least, we have a value of stock investment at $860. So again, another way to think about assets is something that you have on hand. If you had to, you could sell it for monetary value. So a lot of these items here we could sell on Craigslist or eBay in order to make some money off it. And then also any cash in different accounts that we might have. In this case, we have a savings account, a checking account, and an investment account. So adding up all those values, our total assets are worth $18,950. Now in part B, we're working with the total liabilities. In other words, this is the amounts that we owe to others. So going through our items, we can see that the credit card balance is what we owe to the credit card company. And we have a balance of an educational loan of $2,160 that we owe to a lender. So it could be a bank that I have my educational loan from, or perhaps the federal government. When I add those two numbers up, we get $2,395 for our total liabilities. So these are balances that we owe to another party. So part C has to do with net worth. So recall that our formula for the net worth is our total assets, what we own, minus our total liabilities, what we owe. So we're actually going to be using the answers from parts A and part B. So we'll take the $18,950 of assets minus our total liabilities of $2,395, and that gives us a net worth of $16,555. Now in part D, we also want to identify the total cash inflows. In other words, the income that's coming into our account on a monthly basis. So when we look at our items, that would be our monthly take-home salary of $2,185. Now, if you want to double check, when you go through the items, you could see that there are no other forms of income that might be coming in, such as alimony or child support, or perhaps Social Security, or some other amount of money that's coming in. which is why we only have the monthly take-home salary notated as our inflow. And last but not least, Part E wants us to find the total cash outflows. In other words, our spending that occurs during the month. So looking at our different items, again, I'm going to check off all the ones that apply. And it's helpful to think through what is an example of spending money. So we can see each month I have to spend money on rent. I have to spend money on food. I'm spending money on auto insurance. I'm spending money on lunch and parking at work. I'm spending money on clothing. I'm spending money on my telephone bill. I've got a loan payment of $80. I have to pay for electricity. I'm also spending money towards donations. And then I'm also spending money on restaurants. So if we look at each of the values that count as spending, they are fairly small, but they add up. So when I add up all my expenditures, our total cash outflows is $2,040. Now you might ask, well, how come the credit card balance and the educational loan don't count as outflows? Because the way it's written, it's a balance. This is what we owe. It's not the payment amount. So you want to be careful to differentiate between what's an outflow in terms of spending versus what is owed or liability in the form of a balance. Next, let's get some practice with net worth, assets, and liabilities. Again, the formula for this is our net worth equals our assets, what we own, minus our liabilities, which is what we owe to others. So for each of the following, we have to compute the missing amount based on our understanding of how net worth works. So in Part A, we have assets of $65,000 and liabilities of $18,000. So we'll simply subtract these two to get our net worth. In this case, it's $47,000. In Part B, we have assets of $86,500. We don't know the liabilities, but we do know the net worth of $18,700. So if you've taken an algebra class before in the past, this is where we're solving for x or solving for the missing variable. So what we'll actually be doing is we're going to move the net worth on this side by subtracting it and moving the liabilities to the other side by adding it or moving it to the right. And so to rewrite this mathematically, we would take our assets of $86,500 minus the net worth of $18,700, and that'll give us a liabilities of $67,800. And then if you want to double check to make sure your math worked out, you'll go ahead and take the assets minus your liabilities, and it should equal to the net worth of $18,700. In Part C, again, this is more straightforward. We've got our assets of $34,280 minus our liabilities of $12,965. So when I subtract these two, we get a net worth of $21,315. In Part D, our assets is the missing variable. Subtract our liabilities of $38,345, and that's going to equal the net worth of $52,654. So again, we have to rearrange our numbers here a bit in order to get the missing variable. So we'll actually move our liabilities over to the net worth side, and to do that, we'll add it. And so liabilities of $38,345 plus our net worth of $52,654 gives us our assets at $90,999. And again, if you want to double check, I would recommend taking your assets minus the liabilities, and it should match the net worth of $52,654 given here. So this is a good refresher on how the formula for net worth works with a little bit of algebra. Next, we're going to be working with financial ratios. So you're given some information here, and in parts A through D, you're going to be solving for different kinds of ratios. This is how we understand the financial performance of an individual. So with our debt ratio here, that formula is liabilities divided by net worth. So we'll make sure to pull the correct numbers from our items above, and we'll go ahead and take the $7,800 in liabilities divided by our net worth of $58,000, and so our debt ratio is 0.134. In Part B, for the current ratio, that formula is our liquid assets divided by our current liabilities. So looking at the data above, we're going to take the 4,600 divided by the 1,300, and that gives us a current ratio of 3.54. In part C, we're interested in the debt payments ratio. And so here we'll be taking the monthly credit payments divided by our take-home pay. So our monthly credit payments is the 640. We'll divide it by our take-home pay of 2575, and that gives us a debt payments ratio of 0.2485. In part D, the savings ratio is our monthly savings, that's the 130, and we'll divide it by our gross income of 2850 to get a savings ratio of 0.046. In this problem, we're going to be working with the variance of our budgeted versus actual expenditures. So Fran Powers created the following budget and reported the actual spending listed. Calculate the variance for each of these categories and indicate whether it was a deficit or a surplus. Note that the homework asks you to input all amounts as positive values. So even though when we use our calculator to take our budgeted amount, subtract our actual amount, we're going to get a variance that's either positive or negative. And that's going to tell us any negative variances means we have a deficit, and any positive variances are a surplus. So taking our budgeted value for food of 360 minus what we actually spent on food at 298, our variance is $62. In this case, it is a positive variance, meaning we have a surplus. We've got extra money left over that we did not spend all of it on food. Next, we're looking at transportation. We'll take the budgeted value of 320 minus our actual value of 334, and we get $14. In our calculator, you'll note that it's a negative 14, and so a negative value means that we have a deficit. In other words, we spent more on transportation than originally budgeted. Next, let's look at housing. We'll take our budgeted amount of $950 minus the actual value of $982, and so our variance is $32. Again, we can see that we spent more in actuality versus what we budgeted for. Therefore, our variance is negative, meaning we are running at a deficit. In the next category for clothing, our budgeted amount was $110, and our actual spent was $134. So our variance is $24. In this case, we spent $24 more than anticipated, so we're running at a deficit. And then for other personal expenses, our budget was $275, but our actual was $231. So when I subtract those two, we get $44. And so we are running at a surplus here because we did not spend all of our budgeted amount. Next, we're going to be examining savings, and we're actually going to be doing future and present values, things that we learned back in Chapter 1. So use the future value and present value calculations from the Chapter 1 exhibits to determine the following. And again, the homework does have specific rounding rules that you need to follow. So in Part A, the future value of a $600 savings deposit after 8 years at an annual interest rate of 6%. So the formula we're working with, again, is a future value formula. We have a single deposit of $600, and so we need to identify the future value factor. Since it's a single deposit, we're going to be using Exhibit 1A. So we're looking at the period column, and we're going to go down to the 8 years row, because we're looking at 8 years. And the interest rate was 6%, so I'm going to go across the columns until I get to the 6% column. And then going down until I get to my 8-year row, my factor is 1.594. So plugging all that in, I take $600, my deposit, times my factor, and we get a future value of $956.40. In Part B, we're interested in finding the future value of saving $1,800 a year for 5 years at an annual interest rate of 5%. So again, you want to look carefully at what the problem or scenario is stating. We are making multiple deposits once a year for 5 years. So our future value formula is our annual savings of the $1,800 times our future value annuity factor. Because we're doing multiple deposits, we're going to be using Exhibit 1B. So here's Exhibit 1B, and we're going to go to the period column and go down to 5 years. And then we're at 5%, so we're going to go to the column that says 5%. And then going back down to the 5-year row, our factor is 5.526. So plugging that into our formula, we get $9,946.80 for our future value if we save $1,800 a year for 5 years at 5% interest. In Part C, We want to find the present value of a $2,000 savings account that will earn 3% interest for 4 years. So in this scenario, we want to know how much do we have to invest today once and wait 4 years in order to get the $2,000 future savings. So we'll be using this formula here for the present value equals our future savings of 2,000 times the present value factor. Since we're doing a single deposit and we're trying to figure out what that value needs to be, we're going to be using Exhibit 1C. So again, our period going down is the 4 years, and we're looking at 3%, so we'll go to the 3% column, and then moving down until we get to the 4-year row, we get the factor of 0.888. So plugging our 2,000 times 0.888 into our calculator, we get a present value of $1,776. That's how much we need to deposit today and leave it in our savings account for 4 years at 3% in order to achieve $2,000 in the future. Next, we're going to be looking at reduction in spending in terms of future values. Brenda plans to reduce her spending by $50 a month. What would be the future value of this reduced saving over the next 10 years? Assume an annual deposit to her savings account and an annual interest rate of 3%. We're going to be using Exhibit 1B. So we'll have to think about this in pieces. So first, we see that Brenda wants to save or reduce her spending by $50 a month. And we need to put that all together to see what that works as an annual deposit to her savings account. So that's what this first formula here is. Our reduction in annual spending is how much we're going to reduce our monthly spending times 12 months, because there are 12 months in a year. So we'll take the $50 a month that she reduces her spending or she saves, multiply it by 12, and so our reduction in annual spending is $600. In other words, this is the annual deposit she would make to her savings account. So now we want to find out the future value of that. So using this formula here, we'll take the reduction in annual spending we just identified above, and we'll multiply it by the future value annuity factor. And again, why it's the FVA factor is because there are multiple deposits, right? She's saving $50 every month for 10 years. So she's going to be doing multiple deposits. So we'll be using Exhibit 1B as a result. So we look at our period, we're going to go down to 10 years, and we're looking at 3%, so going to the 3% column, and then moving down until we get to the 10-year row. Our factor is 0.744. So plugging our information into our formula, so our $600 that we save annually multiplied by the factor of 11.464. Putting that into a calculator, we get $6,870.40. So if you have any questions, just let me know.